I'm Chitra Nawbatt. Most recently, I was with General Catalyst, which is a large global investor investing in enterprise consumer, fintech, healthcare. So what we want to do is have each of the panelists introduce themselves and then dive into the questions. So starting with you, Geri, if you can share a little bit about your background and what your firm focuses on.
Hi, everyone. Great to meet you all. My name is Geri Kirilova. I'm one of the managing partners at Laconia Capital. We are a B2B software-focused pre-seed and seed fund. We generally lead or co-lead rounds of about 1 to 3 million as a sweet spot, based here in New York, focused on the U.S.
Laurel?
Hi, my name is Laurel Toby. I started out in media as a journalist, and then I started a company. So I was an OG in the internet space. The company was called MediaBistro.com, and it was a marketplace. I then sold the company for a big bunch of money and started investing in tech. And I started a fund about 5 years ago called Supernode Ventures. We invest in early stage, pre-seed and seed, a lot of what Geri does and a lot of what Chitra has done across enterprise, B2B, SaaS, fintech, healthcare tech. Basically, we're a generalist fund. We put in small checks, only 100K, and we don't lead. And that's it.
Hi, everybody. Jillian Williams. I'm at Cowboy Ventures. We are also a pre-seed and seed stage fund based between Bay Area and New York. We are a generalist fund. However, I focus on fintech. Been focused on fintech for the last 6.5 years. So prior to being at Cowboy, which I've been at for a little over a year, I was at Anthemis with Katie to my left. And prior to that, I was at Barclays in investment banking.
Hi, I'm Katie Palenchar. I'm currently a managing director at Anthemis Group, where I lead our venture studio investing and specifically our Female Innovators Lab fund in partnership with Barclays. Anthemis Group invests in pre-seed, seed, Series A, and also on the growth side in insurtech. So we're focused on fintech and insurtech investing. The fund that I'm specifically on focuses on early stage female founders in fintech, investing in US, UK, and Europe. We invest at the earliest stages, often a pitch deck. And prior to this, operational background, had my own company, sold that, went in and worked for the acquirer, and that ended up being acquired as well. So super excited to be here today.
So Katie, let's go further with you. That's a broad scope of investing, each of you actually. How do you think about developing thesis? And a lot of VC firms say, yeah, we're very thematic. But the reality is not everybody is. If you can share.
Sure, yeah. So we look at fintech pretty broadly at Anthemis, and even if look at on our specific fund, I love to give specific examples. Have done everything from in the DeFi space to affinity banking to drones to we recently did a med spa marketplace, and we really look at an embedded finance. And I give all those examples to just show underneath a lot of these business models. At first look at the pitch deck, you're not necessarily saying, oh, wow, this is a traditional capital markets business. But when you dig in further, and especially because we are such hands-on with our lab and studio, you start to see how that business could evolve in fintech. And even if you look at the market now, right? When Apple started, we wouldn't necessarily have guessed that we'd be in the buy now, pay later space, right? And so that's kind of how we approach it, specifically on our fund as well.
Jillian?
Yeah, I'd say that I always try to kind of think about the different things within fintech. And I think our fund does this specifically because we have different investors that have different areas that they focus on. And we try to think about what areas we're most excited about and what within our sectors we think are going to be most relevant in the next quarter. And I think we try to do that on a quarterly basis based off of either different trends that are happening, regulations, etc. However, because we are so early and oftentimes we are investing into a person, an idea, I have to admit that oftentimes we'll then let the sort of tail wag the dog a little bit, because you'll kind of see that there's just something that happens where a bunch of founders are then starting to build in a certain space. And then that kind of leads me to figure out, okay, why is something happening in that space? And then I start digging in there. Or I just end up finding a founder who I just think is one of the best founders that I need to invest into, and realize that, that space that they're building in, I didn't actually know anything about it, but that's actually a really interesting space that I want to invest into.
Laurel, if you could build on that and talk about this notion of pattern recognition, which a lot of VCs talk about, because that is tying into what Jillian is saying, right? Thematic versus, hey, you see one founder or a group of founders building companies that, to her point about being opportunistic, but that also starts to speak to, because you're seeing a pattern of something happening. If you could talk to pattern recognition.
Yeah, there's this whole myth called pattern recognition. It's where VCs talk to their LPs and try to convince them to put money into their funds by saying, hey, I'm a genius. I've seen thousands and thousands of companies, and now I have patterns in my mind. And I'm a living AI. And it's just human nature to see patterns in all kinds of things, right? That's what we're trained to do. So yeah, I'm a pattern recognizer myself. I would say we invest in really early stage. I think all of you guys do, right?
Yeah.
For us, all of us on this panel, the most important thing is the person across the other side of the table, right? And your belief that that person can make the right decisions at the right time for their company. And that is the bottom line. It doesn't matter almost what industry it is, what product it is, it could change. All of it could change. And you have to believe that this jockey is going to ride to the end, right? And that's really the pattern that I'm looking for, is that person.
And what are those attributes like? What?
The attributes are, they're things like resiliency, they're things like leadership, they're things like incredible passion, knowledge of the space that they're going into, the ability to make really tough decisions, capital efficiency, things like that. And you can ask people questions about their past that will lead you to the right answers. And they can't game that if you ask the right questions. Like, for example, I love immigrant founders. I love founders who have grandparents who came from somewhere else, who saw their grandparents struggle, who had challenges as young people, even if they went through to the best colleges and the best schools and were rich kids, they still might have had incredible challenges, or a brother or sister who struggled and they, had empathy for that person. So that's just one example. I don't want to take up too much more time.
And actually, before I get into the next question, just to provide some context before I get into the next question, how much total portfolio companies do each of your firms have? Katie?
Yes, so we are at about 160 across. We have numerous funds within Anthemis Group across the entire Anthemis Group.
What's your check size?
So on our specific fund at Female Innovators Lab Fund, we're investing anywhere from $400K to $1 million. In the past market, that's been leaning more to $1 million. We prefer to lead, but we can do everything.
We look to lead, so our check size across pre-seed and seed will be anywhere from like $500K to $4 million. I think total, we just did our 101 now deal, but I think it's like 51 live companies.
Per fund or for all the funds? Or
For across all
Okay.
funds.
Okay, we have one fund so far, 45 companies, and our check sizes, as I said before, we're about 100K.
Geri?
We're super concentrated even at seed. So we, across 3 funds, our third fund is still pretty early on. We have about 22 companies at the moment. And our check sizes are anywhere from a couple $100,000 up to $1 million.
What did you start with in terms of companies? How many died?
We have.
Sorry, I didn't mean to say it
No,
like
it's
that.
okay.
I'm not challenging
we have 2
her.
that have wound down. One that was an acqui-hire that we lost money on.
Yeah.
So I asked that question because, Geri, then this next question to you, which is how do you think about, and if you can share with the audience, like just notion of being a capital deployer versus value creation. So there's many different kinds of investors, and venture capital is definitely not homogenous. And so how do you can sort of compare and contrast being a capital deployer versus an active value investor?
That's a really good question.
Aren't we all capital deployers, though?
You're all capital deployers, but is everybody a value creator?
Yes! Hell yes!
Really?
Yeah!
Well, what would the alternative be? I mean, I guess you could deploy capital and just lose it all over and over again.
No, but it's just sharing perspective. I mean, not everyone here is just want to share perspective to kind of like demystify and help people sort of understand the difference.
So super quick distinction just for people in the room, right? We often talk about, I think why you're bringing up capital deployment is because VCs are fiduciaries. They have limited partners who put capital into the funds, and there are return expectations of what we're going to give back to our LPs over a certain time period. So rule of thumb for super early stage investing, you're looking at least 3 to 5x net capital returned on a fund level. So if you raise a fund that's $50 million, you should give back $150 million to your LPs. So that's why there's expectations around portfolio company outcomes, exits, unicorns, billion-dollar IPOs, and things like that. It's sort of an ongoing debate in the venture industry, right? Do VCs actually add value? If you survey founders, most will say no. If you survey the VCs, they'll say yes, of course we do. If you look at the academic research on the subject, it'll generally say no. So I think a lot of the value is more psychological in nature. It's actually very hard to determine whether it was value accretive or not. It's possible that founders feel like it is, but it's still not. And so we think about our role as, first of all, doing no harm, first and foremost, right? So even if we can't make it better, we won't make it worse. That's what we try to do. And we function on more of a pull versus push method. So if founders are asking us for help or asking us to interview people or recruit or make business development intros, we will. But we very much try to do it case by case as they need us, as opposed to having a one-size-fits-all model.
Yeah, I think there's but I will say there's different styles of venture. Because whether or not, I think you can argue whether or not a company would have still succeeded, whether or not the VC was actually helpful. I think that is fully an argument that it's hard to actually say. However, there are different styles of venture in terms of there are some funds that are just here's your money, don't want to, I'm not going to really speak to you, but some founders are yeah, that's all I really want, and that's great. And then there's other funds that will be no, I actually want to try to be helpful at least and try to hear the services I want to provide, or here's what I'm going to do, and you need help with hiring. I have a hiring partner that will help you get in X, Y, and Z people, or here I'm going to help you make these BD intros and things like that. Again, the impact, could you have made those hires? Are those hires the ones that are most impactful? Who knows? But there are the different styles of venture that exist. And sometimes that just has to do with who's leading, who's not. And sometimes that just has to do with how the VC wants to operate as a fund.
Our fund is very specifically, we have the lab, the studio, what we call it, that provides very specific resources for our founders and is very intentional in doing so. So that's unique in that we have in-house talent, in-house tech, in-house product, marketing, et cetera. We've earmarked, we have a PR agency that works with our founders, sales coaches, et cetera. But that's really kind of one of the main focal points of our fund, is that what we believe, because a lot of these founders are coming in, I would say 50% of 10 companies that I've worked with in this fund now have changed their business model and or their name, right? So often coming in as a pitch deck. So we're involved in that. And what we believe, because it is so early, that we want to be able to kind of give these companies, kind of the fuel that they need and get them to the next round. But we look at that in a very customized way. And so we even have a specific onboarding once we close an investment that we take our founders through that really helps us understand, okay, which paths to put them on, but having a streamlined process to do that. We're not saying, hey, here's the things, you have to do this, you have to do this, you have to do that. You may already be off to the races with marketing and off you go, but you may need help with recruiting, et cetera. And so that's really what we're continuing to build to support our companies as well.
Let's talk about the current market environment. Laurel, I know you have a perspective I'd love for you to share, which is your thoughts on current macroeconomic. What does this mean for venture capital industry, fundraising, and then finally, advice for founders trying to navigate this environment?
Yeah. So I've been through a few downturns, both as a founder and as an investor. From 2000, when I started my company and raised a little tiny bit of capital, there was a huge crash back then. I don't know if any of you guys know about this. It was called the crash of the internet, pretty much. And I was advised to take .com out of my business name, but that was my business. So yeah, survived that. And I feel like we're entering, another unprecedented era, kind of a nuclear winter again, unfortunately. for a lot of people. But there's good and bad news here. The good news is there's going to be a shakeout of all the weak companies, and the weak venture firms even are going to die. But there's still a lot of money out there, and tech is changing the world. So I also have huge hope for the future. But in the short term, cash is king.
Versus the last 2 years, for a lot of companies, like they have to recalibrate how they think about their metrics as they're thinking about fundraising. So, I mean, for a lot of companies, it's like extending their runway quite a bit as well. But it's also when they do think about fundraising, like the bar has changed quite a bit, and how they have to think about like what their burn multiple looks like, what their revenue looks like, how other funds are going to be thinking about their KPIs is definitely different from what it was previously. And so kind of really thinking about that advice and how they should be monitoring themselves is definitely like a change. And so I think that is something that we've talked a little bit about as well.
But before we move on, can I ask Jillian a question? You do fintech, right?
Yep.
Are you worried about anything in the fintech world in particular because of such high potential rates of default on loans and personal debt that's been taken over the last few years? It's just been such easy money. Like, how is your perspective changing in the fintech investing arena?
Yeah, I mean, I've never really loved the lending market in fintech, to be completely honest. However, if you look at the fintech public market in general, versus the NASDAQ, it's down like about 20% worse than the NASDAQ. So clearly the public market has not loved fintech in general. And that includes like even Square, PayPal, and not just the ones that have gone public recently. And so, I mean, clearly they're kind of bundling sort of a lot of it together. And so I do think that there are a lot more macro environments like the rate environment that does weigh on fintech a lot more heavily. And so and it does not help that fintech has been one of the hotter sectors recently, and so a lot of those valuations are a lot higher in general. And so I do think, especially for the like later stage companies, fortunately you will see, I think we've already started to see it, like there was rumors around like Chime's valuation already coming down and whatnot. And so I do think you'll probably see some more down rounds. But I do think like if you look at the sector overall, like it's still a massive sector, still extremely antiquated. And so there's still a lot to be done there. However, there's definitely been like a recalibration within it.
Last question before our panel closes, which is over the next 3 years, how do you think this industry will evolve? What will innovation look like in the VC industry?
I vote Geri. You predict.
All right, we'll do predictions, and then we can look back on how wrong we all were. So I think regarding like the apocalyptic outlook, I think things are going to be really bumpy short term, but will actually stable pretty close to the pre-2021 trend line. So for something super tactical, if you've already raised money or you're planning on raising money soon, I would look at comps from like 2017, 2018 in terms of round sizes, revenue multiples, valuations, things like that, and use that as like an approximate proxy for where fundraising is gonna shake out after the next 6 to 9 months when things stabilize. And then in terms of industry trends, what we've seen over the last decade or so has been tremendous consolidation of capital into fewer funds and fewer companies. That's part of why we got this explosion in 2021. It's not that so many more companies got funded, it's that the ones that got funded raised massive rounds at unprecedented valuations. Unfortunately, what we've seen is that in times of crisis, that effect actually gets worse. So to Laurel's point about a lot of companies going out of business and a lot of funds going out of business, I think we'll actually see more of that. So I think, unless something fundamentally changes about the landscape, I think that's the direction we're headed in.
But I also mean though, like in terms of like like innovation from the perspective of, and even just your funds, each of your firms, right, are structured differently, right? So Katie's has a lot of structure around, talent, the tech, the marketing, the external PR firm. You've got a firm like Insight Ventures, which is similar, right, in terms of like very rigorous on the value creation. Then you've got like Tiger, which they tell you, hey, we're just going to deploy capital, and then they step away. Then you've got other VC firms or even growth, moving into growth equity, where they're like, okay, well, we'll do just seed, early stage, like very early stage seed, and we'll do like late stage buyouts, right? So the barbell kind of investing. So that's what I mean. Like any perspective on how you think venture capital firms will evolve?
Computers. I think tech. I think VC is so old school and antiquated. We need to be replaced by computers. I'm not kidding. I think their algorithms could do some of our jobs. I mean, I think there is one called Correlation Capital and a few others that actually do these they just scour the web and different data sources and find potential founders to invest in, and then they do it based on that. So I think there will be more of that. All right.
I mean, I think if you look at it, like if you asked a year ago, I think most people were saying they're like, oh, at some point you're just going to have like only the funds kind of like Tiger because like people just want capital. And I think you can kind of see that is maybe not working great. But I mean, that was kind of like, I mean, SoftBank kind of was doing the same model and like that was struggling as well. And so I think you are seeing a little bit of like, a lot of the same models that have existed. I mean, Laurel has a point that like a lot of VC has not evolved in a long time, for better or for worse. I mean, there have been other models that have popped up and that have then kind of faded away. I'm not saying like permanently, but that I think there is something that has kind of stayed true around having some of these like stage-focused funds. I think you'll still have like the Andreessens that have gone a lot more kind of across the sector. I mean, across the stages and whatnot. But I think you'll kind of continue to see all these funds doing sort of the different models, especially which is like, I think there's going to continue to be more money in the space. Like, I don't think that's going away. And so we're just going to continue to see more innovation and then more these types of funds kind of fall away that didn't work. And then more money come into the space and more try everything and try new styles of venture. And then something will work and then something will change. And so I think there's just like going to be increasing experiment within the space because especially relative to other industries like traditional private equity and whatnot, it's still a smaller industry.
Yeah, I completely agree with Jillian. And to add on to that, I would say that like these differentiators in funds, and not that one way is the best way, the other way, will actually continue to be more prevalent and talked about because it is continuing to be competitive to get deals, competitive to raise money, et cetera. I mean, and I think venture capital as an asset class will be a part of corporate strategy as well. Like, I often say Sesame Street has a venture arm. Right? And so I think as so many people have been involved in venture and what that looks like everyone's going to have to get even more razor sharp. And just even like in the question that you asked all of us of like where we're focused and value creation, I think even like 10 years ago it was just like, well, VC is VC is VC. Right? So I think continuing to get laser like sharp on what that looks like for each fund is going to be pretty interesting and unique, and see how it plays out.
All right, guys.
Thank you so much. Big round of applause for our panelists.
Great job. All right.